Monetary policy and the central banking system are two fundamental components of modern economies. They play a critical role in managing economic stability, controlling inflation, fostering economic growth, and ensuring overall financial well-being of a country. Understanding these concepts is essential for grasping how economies function and how governments and central banks work to keep them on track. What is monetary policy? Monetary policy refers to the actions taken by a country's central bank to manage the supply of money and interest rates in the economy. The primary objective of monetary policy is to achieve economic stability by controlling inflation, managing unemployment, and promoting stable economic growth. There are two main types of monetary policy: expansionary and contractionary. Expansionary monetary policy. This type of policy is used when the economy is sluggish or in recession. The central bank may lower interest rates or increase the money supply to encourage borrowing and investment. Lower interest rates make loans cheaper, which can stimulate consumer spending and business investments. As a result, economic activity picks up, leading to job creation and growth. Contractionary monetary policy. This policy is applied when the economy is overheating or experiencing high inflation. The central bank may raise interest rates or reduce the money supply to cool down the economy. Higher interest rates make borrowing more expensive, which can reduce spending and investment. This helps to control inflation and prevent the economy from overheating. The role of central banks. Central banks are the institutions responsible for managing a country's monetary policy. They're often independent from the government, which allows them to make decisions based on economic indicators rather than political considerations. The central bank's independence is crucial for maintaining trust in the financial system and ensuring the monetary policy decisions are made in the best interest of the economy. Some of the key responsibilities of central banks include: Number 1, setting interest rates. One of the central bank's main tools for controlling monetary policy is setting the benchmark interest rate, often called the discount rate or policy rate. This rate influences the interest rates that the banks charge their customers. By raising or lowering this rate, the central banks can either encourage borrowing and spending or discourage it. Number 2, regulating the money supply. Central banks control the amount of money in circulation. They can increase the money supply by purchasing government bonds or decrease it by selling them. This process is known as open market operations. Number 3, serving as a lender of last resort. During financial crises, central banks can provide emergency funding to banks and financial institutions that are facing liquidity issues. This helps prevent panic and ensures that the financial system remains stable. Number 4, managing foreign exchange reserves. Central banks also hold and manage a country's foreign exchange reserves. These reserves can be used to stabilize the currency, especially in times of economic uncertainty or currency volatility. Number 5, supervising and regulating banks. Central banks often oversee commercial banks to ensure they operate within regulatory framework. This includes ensuring that banks have enough capital to withstand financial shock and that they follow sound lending practices. Well, how do monetary policies impact the economy? Well, monetary policy has a direct impact on several aspects of the economy, including inflation, employment, and economic growth. Inflation control. One of the primary goals of monetary policy is to control inflation, which refers to the general increase in prices of goods and services over time. If inflation is too high, it can erode purchasing power and destabilize the economy. Central banks use contractionary monetary policy to curb inflation by reducing the money supply or raising interest rates, making it more expensive to borrow and spend money. Employment. Monetary policy also influences employment levels. When the central bank lowers the interest rates, it can stimulate economic activity, leading to job creation. Conversely, when rates are increased, economic activity may slow down, potentially leading to higher unemployment. Central banks aim to balance these effects by maintaining a level of economic activity that supports stable employment. Economic growth. By managing interest rates and the money supply, central banks can influence the overall level of economic activity. Lower interest rates generally boost investment and consumer spending, leading to higher economic growth. On the other hand, high interest rates can reduce spending and investments, slowing down growth. While monetary policy is a powerful tool, it is not without challenges. Central banks must carefully consider various factors when making decisions, as the wrong policy move can have significant consequences. For example, timing and lag effects. Monetary policy does not affect the economy immediately. There is often a time lag between when a policy is implemented and when its effects are felt. For example, it can take several months for changes in interest rates to influence borrowing or spending behavior. This lag makes it difficult for central banks to time their policies perfectly. Global influences. In today's interconnected world, global economic conditions can influence a country's monetary policy. For example, if a major trading partner experiences a recession, it could impact the domestic economy, making it challenging for the central banks to achieve its policy goals. Political pressure. Although central banks are typically independent, they may still face political pressure from governments, especially during election periods. Politicians may push for lower interest rates to stimulate the economy, even if it is not the best decision for long-term stability. And finally, public expectations. Public perception and expectations play a significant role in the effectiveness of monetary policy. If people believe that inflation will rise, they may demand higher wages, which can lead to actual inflation. Central banks must manage expectations carefully to maintain credibility and ensure their policies are effective. Well, what are some examples of monetary policy in action? Well, to better understand how monetary policy works, let's look at a few historical examples. Number 1, the Federal Reserve and the Great Depression. During the Great Depression of the 1930s, the US Federal Reserve initially made some policy mistakes by tightening monetary policy when the economy was deep in recession. This worsened the economy downturn. Later, the Fed adopted more expansionary policies, which helped the economy recover. Number 2, the 2008 financial crisis. During the global financial crisis of 2008, central banks around the world, including the US Federal Reserve and European Central Bank, implemented aggressive expansionary monetary policies. They lowered interest rates to near zero and used unconventional tools like quantitative easing, which means buying large amounts of government securities, to inject liquidity deliberately into the economy. These measures helped to stabilize the financial system and supported economic recovery. Number 3, Japan's lost decade. In the 1990s, Japan faced a prolonged period of economic stagnation and deflation, often referred to as the lost decade. The Bank of Japan's monetary policy was initially too conservative, failing to combat deflation effectively. Later, more aggressive monetary policies were adopted, including zero interest rates and quantitative easing, but the recovery was quite slow. To conclude, monetary policy and the central banking system are crucial for functioning of modern economies. Central banks use monetary policy to control inflation, manage employment levels, and promote sustainable economic growth. Though tools like interest rates, open market operations, and the regulation of money supply, central banks can influence the economy in significant ways. However, implementing effective monetary policy requires careful consideration of timing, global conditions, and public expectations. By understanding these concepts, we can better appreciate the challenges and responsibilities that central banks face in maintaining economic stability.